All right, so we're going to start with an income statement or a statement of comprehension income for grade 10. So I will share this question in the description below. So this question 1, GB Fashion House. The following information was taken from the records of GB Fashion House on 28 February 2022, the last day of the financial year. Therefore, it indicates on our financial timeline that if 28 February is the last day, the first day of the financial year is 1 March 2021. The markup is 60% on cost. So we are required to complete an income statement or statement of comprehensive income. Balance sheet items are given to us and nominal accounts and adjustments. Now, I'd always advise my students when we start an income statement, your first step is to start with the format. So I'm going to open my bracket, sales. I look for sales amount, 947,360 minus debtors allowance, 1,250. Cost of sales, 520,000. So I'm only opening up my income statement by adding the accounts that should be included and opening brackets for the amounts, as we are not yet reading any type of adjustments. All right, so we go down to rent income. Let's see if I make this fit better. Rent income, open bracket, there we are, 32,760. Discount received, 1,690. Water and electricity they have, discounts allowed, packing material. So let's see which other items should be included. Rent income is there, water and electricity is there, telephone. So add it to the expenses. Telephone, open a bracket, 7,848. Discounts allowed is included. Bad debts. Open a bracket, 5,288. Your brackets are very important as it allows for part marks. Advertising, added to our expenses. Advertising, open a bracket, 23,600. Discount received is already included. Insurance, open a bracket, 9,600. Stationery is an expense, it's added. Stationery, 4,680. Interest on fixed deposit. Remember, interest, I want to be alone. You never add interest to your operating income. Interest is a finance cost or finance income. It's added at the bottom of your income statement. So we have operating profit, then it's interest income. And there I will add my interest on fixed deposit of 3,600. Packing material is included. Salaries. Interest on loan again is a finance cost, not an operating cost. Therefore, it is added to the bottom of the income statement. So we have our operating profit, our interest income. Then we have profit before interest expense. And we have interest expense. Open bracket, and interest on loan is 6,600. So this is the information from the pre-adjustment trial balance that was given to us. Let's start with our adjustments. Adjustment 1, rent was received and recorded till March 2012. Therefore, I'm going to draw a quick timeline on top. It will indicate, so the year ends 28 February. The financial year starts 1 March 2021. If we have received rent until March, we have received rent for 13 months. So for adjustment A, I'll use the rent amount 32,760 divided by 13 months. Therefore, the rent is 2,520 per month, and 1 month is too much. So I need to take it out as it is an income received in advance. So this is an income received in advance, which would then be added to your trade and other payables note for your balance sheet. Adjustment B, a debtor in Velodia returned stock. So this is a DAJ transaction with a cost price of 1,150. No entry was made. When we have sales or returning of stock from a debtor, 4 accounts are then going to be affected. So I'll have debtors allowances and debtors control, cost of sales, and trading stock. Debtors control is an asset plus minus, trading stock asset plus minus. So the bottom 2 works with the cost price. The top 2 works with your selling price. We already have the cost price of 1,150. So if stock is returned, I have more stock. And then cost of sales will decrease with 1,150. There's the total on the debit side. That's on the opposite of the total, we would minus in the income statement. Let's calculate our selling price. Now, I have seen students still battling with this calculation. The easiest is to draw a triangle. You have your selling price on top, cost price 1, profit. If the profit is 60%, therefore it's 1,60. So I will then take my cost price times 1, profit to get selling price. And if I'm looking for the cost price, it's selling price divided by 1 comma profit. So this instance, I'm looking for selling price. So our close selling price will be cost price times 1 comma profit. 1,150 multiply 1 comma profit. And my selling price is 1,840. So if the debtor returns goods, he owes us less 1,840 in debtor's allowances. Every debit has a credit, is an expense. Expense always debit 1,840. So you have to remember that expenses decrease, or debtor's allowances decreases sales. So minus that selling price of 1,840 and cost of sales minus the cost price of 1,150. Adjustment C. If Whittington, a debtor, whose account has previously been written off as irrecoverable, paid 640 Rand by EFT, the bookkeeper entered the following as. So they debited bank, they credited debtors control. Remember, if a debtor was previously written off, it's a bad debt. He is not a debtor anymore. When he then comes back and pays us, he is a person with a conscience. And we record it as bad debts recovered. So first we'll need to fix the mistake. If you were doing a balance sheet as well, you would then effective minus your debtors control with 640. And that would be added to bad debts recovered. So bad debts recovered is an income, an operating income. Bad debts recovered. And it's 614. Bank stays the same. We did receive. There's no mistake with the bank amount. Adjustment number D. The owner took stock with a selling price of 880 for personal use, but it was omitted from the accounting records. Remember, the owner always takes stock at cost price. So for this transaction, we would record drawings as debit. Let's calculate that cost price. It's 880 is the selling price. Divide by 1 comma profit. Selling price 550. So drawings will debit with 550 and trading stock will minus, which means it will credit with 550. There's no direct impact on my income statement. Next transaction. A physical count on trading stock revealed the following. So the trading stock on hand was 54,300. Remember, we now have to calculate, do we have a trading stock surplus or deficit? It is important to keep in mind all previous transactions regarding trading stock. So in order to calculate this, I'm going to do it at the bottom. E. My trading stock according to my trial balance is 57,000. So I'll start 57,000. Let's check previous adjustments. Adjustment B, we increase trading stock with 1,150. And adjustment D, we decreased trading stock with 550 from the owner that withdrew stock. So now my trading stock, 57,000 plus 1,150 minus 550 is 557,600. We need to compare this to the physical count. So in the books, the T account of the general ledger, trading stock is 57,600 minus what is in my physical warehouse? We only have 54,300. Therefore, we have a 3,300 difference. It's important to note when your books is more than your physical count, you have a deficit. When your books is less than your warehouse, you have a surplus. So therefore, we have a trading stock deficit. And a trading stock deficit is an expense. So I'll add it to the expenses. Trading stock deficit. Then show how you got to that amount. So I'm going to start with the trading stock account. It's 57,000 plus 1,150 minus 550 minus the warehouse, the physical count, 54,300. And we got 3,300. You show the calculation as part marks are awarded. No bracket, part marks cannot be awarded. Then we remember also we had stationery on hand. So if the stationery is on hand, it means the stationery was not used. And therefore we will minus unused stationery, 342, and this will then impact consumable stores on hand, which is in your inventories note in your balance sheet. Adjustment F. Advertising includes an amount for a 6-month advertising contract. The advert runs from 1 January to 30 June and is fixed at a monthly fee of 4,175. So they give us the monthly fee. Be careful, some tests would give you an annual fee and you will need to go and calculate the monthly fee. So let's quickly look at our timeline. It ends 28 February, begins 1 March. This contract runs from I'm just looking for a different color. This contract runs from 1 January until 30 June. You can see some is in my timeline, that's perfect. But there's a part that's too much, which is a prepaid expense. Let's count how many months. It's March, April, May, and June. There's 4 months, 2 months. So 4 months times our monthly fee, 4,175. Gives us 16,700, which is a prepaid expense. And prepaid expense we will need to minus from advertising 16,700. Next adjustment. The telephone account for February has not yet been paid. This is an accrued expense. Accrued, you plus with your income statement. So telephone plus and the telephone was 710. H. A debtor, D. Gracie, who owed us 1,355, was declared insolvent. A dividend of 60 cents to the rand was received and recorded. Write off the remaining debt as irrecoverable. So he owes us 1,355. They say a dividend of 60 cents is what we received. So that went to bank. It was a received amount. The remaining, so there is 40 cents in the rand remaining. Because remember, 1 rand has 100 cents. I take off the 60 cents per rand that I have received. There's 40 cents remaining. So it's 1,355. Multiply the 40 cents. And it's 542, which was reported as bad debts. So there we have bad debts plus 542. Next adjustment. M. Irk, a debtor who owes 900 for the past 4 months, must be charged 8% interest on his overdue account. So this is interest that we would receive. It's part of interest income. So to calculate, I'll say he owes us 900 times his interest rate is 8%, times it's only for 4 months, it's 4/12. 900 times 8% times 4 divided by 12, it's 24 rand, which is interest on overdue debtors. At my interest income, I will add 24 rand. J. A loan is repaid in annual installments of 10,000 on 1 July, and all payments have been made and recorded. Calculate the outstanding interest. Interest on loan is not capitalized. If it is not capitalized, it means that the interest is not added to the loan. If there is outstanding interest, it is an accrued expense. If interest was capitalized, we would add that interest to the loan. Then we would have a loan account and an interest on loan account. Not capitalized, we have the interest on loan and accrued expense. So let's calculate that interest. I'm going to use the back of this. So our loan amount is 100,000 at the end of the financial year at 18%. So let's draw a timeline. It starts 1 March, 28 February. They tell us that on the 1st of July, we repay the loan of 10,000. Here the balance of the loan is 100,000 at 18% interest. So 100,000. That means at the beginning of the financial year, my balance was 110,000. When we now calculate the interest, I'm going to calculate from March to July, which is March, April, May, June. It's 4 months. Then I'll calculate from July till February, which is July, August, September, October, November, December, January, February, which is 1, 2, 3, 8 months. So let's first start. From the beginning, the balance was 110,000 times 18% interest, which I saw next to loan, 18% per annum, times 4/12. So it's 110,000 times 18% interest times 4 divided by 12, which gives me 6,600 for that time period. The next time period, now from here, we already paid 10,000. Now my loan is at 100,000 times 18% times 8/12. 100,000 times 18% times 8 divided by 12 for 8 months, 12,000. Add the two together. In total, I should have received 18,600. How much did I receive? I only received 6,600 for the interest on the loan. So I've only received that part, or only paid, that part of the loan. We still have 12,000 outstanding. So for the interest on the loan, I have to add 12,000 for interest on loan. And there will also be accrued expense. Okay, depreciation of 111,520 must still be provided for. So depreciation is an expense. And the depreciation, 520. L. The following details of an new employee day theory were omitted from the salaries journal. So let's do him over here. So your salaries journal would look like gross salaries. Then you have your deductions. Pay as you earn. UIF. Pension fund. So these are all your deductions. Then you have your net salaries. Then you have your contributions. Contributions, the company contributes 4% of the gross salary to the pension fund. So we have a pension fund contribution and UIF on a rand for rand basis. So that's what my salaries journal would look like. The gross salary is stated at 20% of 20,000. 20,000. Pay as you earn is 15% of gross salary. So 20,000 times 15% of gross is 3,000. UIF is 1%, so 20,000 times 1% is 200. Pension fund, they give us at 2,650. Your net salaries is gross salaries minus deductions. So it'll be 20,000 minus 3,000 minus 200 minus 2,650. 14,150. Contributions. Pension fund is 4%. The company contributes 4% of employees' gross salary. So 20,000 times 4% So the contribution for pension is 800 and UIF is on a rand for rand basis. So this is 200. This should be 200 as well. When we have to record this in my financial statement, gross salaries goes to your income statement as salaries. All the deduction goes to your balance sheet because there are liabilities as trade and other payables. So note number 8, trade and other payables. The same for net salaries. That will go to the balance sheet. Trade and other payables known as creditors for salaries. Contributions are added to your income statement plus the balance sheet because it's an expense. So you will add it to the salaries account. And also the business is liable to pay that. That's also recorded as part of the liabilities. So this income statement part will go to your salaries and that will go to your balance sheet. Note number 8, trade and other payables. So we are now able to record this in my income statement. So at the salaries, I'm going to add the gross salaries of 20,000. I'm going to add the contributions of 800 for pension plus the 200 for UIF. So you add gross salaries and all contributions to the income statement. And then it says, all right, and that's it. All right, so now we can close off this income statement. Let's start sales. So for sales, it's 944,270 cost of sales. In a bracket, because cost of sales is an expense, 518,850. Then it's sales minus cost of sales. Sales minus cost of sales will give you gross profit. Gross profit 425,420. Other income, we'll start with rent income, 32,760 minus 2,520, 30,240. Discount received stayed the same. And we added bad debts recovered. So then we will add up all the operating income and add it to other operating income. Gross operating income, we will add gross profit plus operating income. Gives us gross operating income. So I'll take gross profit plus other operating income. Then we get to other expenses. So water, electricity is there, discounts there, packing material. Telephone, 7,848 plus 710. 8558. Bad debts. $5,288 plus 542. 5,830. Advertising 23,600 minus 16,700. 6,900. Insurance 9,600. Stationery 4,680 minus 342. 4,338. Salaries 96,000 plus 20,000 plus 800 plus 200 gives me 117,000. All right, now we need to add up all of the operating expenses and add it to other operating expenses. 500 plus 5,112 plus 8,558 plus 5,830 plus 6,900 plus 9,600 plus 4,338 plus 117,000 plus 3,300 plus 111,520. In a bracket, because remember it's an operating expense, expenses decreases profits. 278,648. Operating profit, I'll look at gross operating income minus operating expenses. So gross operating income minus operating expenses. Operating profit, 179,342. Interest income is 3,624. Profit before operating expense, I'll use my operating profit plus interest income. So my profit before interest expense is 182,966. Then interest expense, in a bracket, expenses decreases profit. We have our 6,600 plus our 12,000, which of course is 18,600. So to get the income for the year, I use the profit before interest expense minus interest expense. And my profit for the year, 164,366. And there is an income statement or a statement of comprehensive income. Right, thank you for watching. Please share the video with your other accounting classmates. Thank you, everybody. Bye-bye.